Alternative investments are typically defined as any investment other than traditional stocks or bonds. They are not traded on an exchange or in public markets, and you may have heard them referred to as the private markets funds, alternatives, or simply alts. This very broad definition means alternative investments can include almost anything, such as antiques, baseball cards, fine art, and even wine. We won't weigh in on those categories as plausible investments or not. We will focus on the primary asset classes and strategies, which include private equity, private credit, real assets, and hedge funds. These asset classes are separate from actual investment structures, types, or vehicles, and should be thought of as broader investment categories or a diverse set of strategies. Private equity investments provide the potential for higher returns. Private equity fund managers invest in private companies and actively work to facilitate positive change and/or to maximize business growth. Private credit funds are designed to generate current income by investing in the debt of strategically identified companies, either by making loans to these companies or acquiring loans in the secondary market. Real assets, such as real estate, infrastructure, and natural resources, offer diversified sources of return and/or income and may provide a hedge against inflation. They involve tangible, physical assets whose value is derived from their use. Hedge funds represent a diverse group of investment strategies that can deliver investors enhanced returns, capital preservation, risk mitigation, and greater portfolio diversification across various market conditions, with the ability to be long and short segments of the market. Within each asset class or strategy, there are sub-strategies that focus on specific types of companies, specific areas of the market, or specific investor outcomes. Now, why would an investor consider an allocation to alternative investments? For years, investors have accepted the traditional 60-40 portfolio allocation as the market standard. But what if public equity returns fall short? Or the correlation between public equities and fixed income increases and the asset classes end up moving in tandem? In market environments with increased volatility and lower return projections, the standard 60-40 portfolio allocation to the public markets will likely continue to be challenged. Adding an allocation to alternative investments may help create more durable portfolios that seek to enhance returns, lower volatility, and diversify risk over the long term. While alternative investments have many capabilities, there are three distinct features that stand out. The first is enhanced return and income potential. Historically, alternative investments have delivered higher returns and income than traditional public equity and fixed income investments. The second is broader diversification and lower market correlation. Alternative investments span multiple asset classes and investment strategies that do not typically move in line with traditional stocks and bonds. This helps to dampen volatility, increase diversification, and lower correlation in a portfolio. The third feature is a larger opportunity set. Alternative investments offer exposure to a vast number of unique investment opportunities away from long-only, publicly traded stocks and bonds. In addition, the number of public companies has been shrinking, and the bulk of activity and innovation is occurring in private companies. With enhanced return and income potential, broader diversification, and a wide array of unique investment opportunities and strategies, alternative investments can be a valuable addition to a portfolio. Financial professionals should determine whether alternatives are appropriate given each investor's cash flow needs, risk profile, time horizon, and level of sophistication, among other factors. Now that we have covered what alternative investments are and some reasons to consider them as part of a well-balanced portfolio, it is important to understand some of the complexities. Alternative investments are complex products. Each fund or strategy differs in terms of management, process, and approach. In addition, not all managers are the same. The experience, skill level, and track records of managers may vary greatly, and as a result, the dispersion or difference in returns is much wider than it is in other asset classes. Therefore, a key to investing in alternative investments is conducting thorough research and being well informed. No discussion on alternative investments would be complete without mentioning some of the key risk considerations. Transparency. Alternative investments may not offer the same level of transparency as traditional investments, which are required to provide frequent and full disclosures. Liquidity. Private market strategies have fund and structure-specific parameters for redemptions or withdrawals. Some funds may allow for limited redemptions or withdrawals, but many do not allow any redemptions or withdrawals during the fund's entire term, often 5 to 10 years or more. Fees. The fees for alternative investments are generally higher than traditional investments. This is due in part to the complexity of managing the underlying investments and the depth of the resources necessary to properly source, diligence, and monitor investments. While alternative investment fees are typically higher and more complex than traditional investments, they should be considered in an appropriate context and evaluated in relation to the level and quality of management that is being provided. Leverage. Many alternative investment strategies utilize some form of leverage which magnifies the impact of returns and risks. If used appropriately, leverage has the potential to offer high returns, but it may also increase downside risk. This video provided a brief overview of what alternative investments are and why you should consider allocating to them. Please contact iCapital, a fund manager, or your wealth management platform to learn more.